there, but there's so much money still in the economy, we can still expect this bubble to keep inflating, right? Before we get like a massive correction. If we keep overstimulating, we're going to get a big sell-off at one point. But then at that point, that's a buying opportunity, buy the dip, right? If you get like I got a few of my friends asking me, when is Bitcoin going to fall 80% the next time? Like, man, I really don't know. Like, if I knew, I would already, do something about it. But if it happens, go, all in.
Hey, welcome back to the Mining Pod. It is Jackson Hole season, so we brought on a special guest that we've never had on the show before, Vuk Vuković of Orca. Thank you for joining us today. We're really excited for this conversation.
Thanks. Appreciate it. Thanks for the invite, Bill.
Yeah. So we have Jackson Hole is coming up on Thursday, Friday, Saturday. For those who don't know, every year, what should we call them? Like the tastemakers for the global economy gather to discuss where the interest rates are going to go. As Bitcoiners and as listeners to the show will know, that has a lot of implications for markets, especially for the risk assets that we like to talk about, Bitcoin mining stocks, AI, HPC, and then of course Bitcoin. And so we were curious just to bring on someone who has a larger macro perspective on these topics to walk through it with us. And through a great connection from my friend Scott. Thank you, Scott, for making this possible. We have you on today. So let's go through a little introduction with yourself first. And then we got about 45 minutes or so to kind of talk through the aforementioned topics.
Okay, great. Again, thanks for the invite. Happy to be on the show. So a little bit about me. So I come from a mostly academic background. So we run a hedge fund, Oraculum Capital, but it got started as a kind of a scientific experiment gone wrong, basically. So we wanted to do this new methodology of, when I say we, I mean myself and my two partners. One is a physicist, one is a computer scientist. I'm an economist. I did my PhD at Oxford. And while I was there, we were kind of developing this methodology for predicting elections. So we did this. We were very accurate in predicting both Trump and Brexit in 2016. When I say accurate, I mean like with a 1% margin of error for like every swing state in here and for the Brexit referendum as well. So that was pretty awesome. And this encouraged us to kind of start a market research company in Cambridge in the UK. We did that for a couple of years. And after the Biden election, another one that we got accurate, this time for paying clients, now with a company, right? We decided to see if this methodology can be applied to markets, because it's the same logic, right? We're trying to ask people for like a wisdom of crowds type of questioning and a network analysis of their biases, trying to figure out where the signal is taking us, whether it's, typically perfect when you have binary outcomes like elections or like, up bullish or bearish, right? And so I tested this for 2 years. I took $20,000 of my own money, brought it up to over 50, and we kind of, this encouraged us to start a fund. So we launched in 2023 in February. Scott was helping us, our mutual friend, to launch this in America, one of our partners as well. And we started with about 700K, mostly FFF, Friends, Family, and Fools. That's how we started. And then now we're at 75 million. So it's been a nice ride in 2.5 years.
That is a pretty solid ride. I like the last F there. It's funny. Okay, so that's Orca in a nutshell. You guys are also trading a lot on volatility, is my understanding. Like you like and prefer markets that are a little bit more volatile because of that yes or no. Like you want that in or out. Right?
Exactly. So it's directional trading, right? So we're only buyers of vol. So we buy options on the S&P 500. So we never sell, meaning that when there's a vol event in either direction, right? It can be up or down. We're riding the volatility up. Typically, we're riding the price of options up. So for example, our best performance this year came in April when everything was selling after the tariff introduction, which was great for us. But then afterwards, when vol is expensive, it's a bit more difficult for us to make money. But before, we can have, when there's think of it this way. So most of the time, our methodology is not going to make a lot, but then you have like 5 or 6 times a year when you have some spikes, something happens, either up or down. And that's when we make like 5, 6, 7% per week. And that explains our kind of 30% annualized returns.
And hence the importance of an event like Jackson Hole or other meetings with again, these big wigs making decisions on monetary policy.
Absolutely. So before April, the last event that we made 7% in a week was with the last Fed meeting on December in last year, when Powell was very hawkish. Markets fell down, I think 3%. The S&P fell down on the day, and we made like 7 on those trades. So it was nice.
Let's go a case study for that December then. So
sure.
My understanding is you guys have this survey, incentivized survey. People fill that out and they can win rewards based on doing that. And we can even link this if people are interested. I don't know how you qualify people.
Absolutely.
But you use that to source the wisdom of the crowds, like you mentioned, and then you also do some survey work and analysis work to understand if these are like qualified people to understand things. And then you guys sort of place your bets based on like the sentiment that you understand.
So the way it works is it's a combination of wisdom of crowds, meaning I ask you. So let's use the election example. So for example, I ask you who's going to win, right? Trump or Harris, for example, Trump or Hillary. And then it's a question of not who you're going to vote for, but who you think is going to win. So a similar method was used. I don't know if you were following it. It was called the neighbor method. There was one French trader who used it on like Polymarket. Yeah. So that we did this back in 2014, 15, right? And used it for the elections. And that's a great question because it kind of forces you to think about the outcome rather than your own preference. But then the second question for us is very important. That's the neighbor question, right? What do you think your people around you, right? So if I'm asking you, let's say you're a Republican or a Democrat or whatever, but you're surrounded by, like-minded people, you're going to, be biased one way. But if you're surrounded by people who are thinking differently, you're going to be biased in a different way. So that's the whole crux. And the same logic is applied to markets, right? Because it's a binary outcome. It's either up or down. And we tested this for a while, as I mentioned, and it was so in terms of like you mentioned the qualification of people. For us, it matters if they're following the markets. Like, so when we did elections, we needed political junkies. Now we need market junkies, like people who are kind of invested in it. We used to do like crypto before, in a sense of trying to predict it, but I don't think we had a good enough of a group. I think everyone was just bullish all the time, which is great. But I can do it. I can do it for Bitcoiners. Yeah, exactly. But I can do it even. I can do it. I can place longs every day. It wouldn't make much of a difference, right? I need like a little bit of variation, right?
And there's definitely a lot of volatility in crypto, but it's just makes no sense when it happens sometimes, or like why something goes up or down. I mean, you would know more, but that's my opinion from looking at the charts for 8 years. We can
come back to that. I would love to talk about it. Yeah, for sure.
Okay, so that makes sense. So what's key moving forward in talking about the Fed decision this week? Well, it's not a decision this week, but like we're going to get a better understanding of what Jerome Powell's thinking going forward. And there's a few things to like consider. One, tariffs, obviously. Two, pressure from the Trump administration to lower interest rates in general. And then 3, just looking at the market, I noted in your recent write-up in your newsletter that consumer price index went down, which was good, but the production price index went up this last month. And so you kind of have like 2 different indicators pointing different ways. Market seems to be strong, but maybe it's overheating. And so Jerome Powell and the other people in the Fed have kind of a tough mandate in their hands where they have a presidential administration that is going to put more pressure on them than ever, whether that be on Fox News or by implementing tariffs. And then they also have a lot of different market signals about whether they should cut, sustain rates, probably not increase rates at all, but at least sustain them going forward. So I'd like to get kind of your thoughts on what you're thinking going into Jackson Hole this week.
Sure. So on one hand, I do get why the administration wants them to do this. Like, it's clear in a sense that their number one, we can call it KPI, but something that they're really concerned with is the 10-year yield, right? The yield on the 10-year bond. Why? Because they're running huge deficits. They're increasing the debt, and financing that at 4.5%, 5% is it would be better if it's down to, if the interest rates with what Trump wants at 1%, then your borrowing costs go down significantly, which again encourages you to keep running the deficits, right? Keep being fiscally responsible. So that's a bit of a problem. Again, it's not. I know that like this is a standard topic with like fiscal conservatism here. The U.S. is a bit different than most other countries just because you have unlimited demand for U.S. debt, right? So every pension fund in the world, look at its balance sheets; it's full of U.S. bonds, right? So U.S. debt is someone else's assets. The rest of the world holds U.S. debt as assets. And why? Because you know that the country is never going to go bankrupt, and it gives you a 4.5% return on a holding of a couple of trillion is fantastic, right? Yeah. If you're a pension fund or if you're a big investor. So obviously the demand is huge, right? On the other hand, obviously it's better for the government to have this cost go down because your interest, the borrowing costs, the interest that you're paying is getting pretty substantial. I think at one point there's a lot of these research papers saying that when a country's interest payments are higher than defense spending, it's typically a sign of decline. I don't subscribe to that. I don't think that's the case. I think the U.S. exceptionalism is something else, but we can talk about that.
Yeah,
it's a different topic. But again, I wanted to say I do understand why the administration wants to do this. So when they want to pressure, they can do it for fiscal policy, right? They can lower the supply of bonds. There's been some hints that they might do that, but it's a much better way if the Fed does it, right? If the central bank does it, then by lowering short-term rates, you're basically affecting the long end of the curve as well.
Yeah.
And this kind of reduces borrowing costs across the board for the government for both short-term and long-term debt. So that's one of the reasons why Trump is so adamant and so persistent in trying to have them cut sooner rather than later. And to be honest, this is going to happen, right? So we know that Powell is out in May, so his term ends. Trump is going to appoint someone else. It's going to be a dovish governor, whoever that is. I'm sure they're going to appoint someone who's decent, who's good.
Yeah.
But it's going to be a dovish Fed chair, and they're going to cut rates. It's just a matter of time and a matter of how much. And that's one of the reasons why we're trading at all-time highs, because markets are already anticipating this, right? They know that Trump is going to put someone who's dovish, that the Fed next year is going to cut aggressively. But the question is that sound policy?
You ever get into your buddy's car and think, dude, how do you live like this? There's half-eaten Taco Bell on the console, a pile of garbage and fast food cups and bags, rumbling in the trunk. You look behind you under your seat and you're pretty sure you saw something move, but you don't know what? Well, how do you think your Bitcoin miner feels if you're not keeping on top of your filtration game? Y'all need to get on Colorado Air Filters. Colorado Air Filters is a major supplier of air filtration systems for Bitcoin mining sites. And they're currently running a summer sale on their inventory, so now is the time to act. Whether you need HEPA filters, new shipments or installations for your containers or your large-scale mining facilities, retrofitted buildings, Colorado Air Filters has it all. And units are ready to sell now. Contact sales at coloradoairfilter.com and use the code MININGPOD to claim 15% off today. Again, that is sales at coloradoairfilter.com with code MININGPOD.
You had a great line in your piece that for you guys as a business, it'd be great to cut rates, but for
me
the
personally
US,
as well. For me personally as well, I would get a loan, cheaper loans, right?
Yeah,
fantastic.
Yeah,
I just moved to the city. I can I can live at large. Then I'm kidding, but yeah, it would be good because we would ride the way all the way up, right?
Yeah.
It would be great, but in long term, I don't think it's good for the country, right? Now we can go back to Jackson Hole a little bit later in terms of like what Powell might do, but on the topic of interest rates, I think it's like, so I read this great book, Chancellor was the author, called Price of Interest.
Yeah, the price of
have
interest. Yeah, it was in your, I have my notes here, but
yeah, it was a pretty good book. I recommend it because he talks a lot about like, how the Austrian School of Economics would think about something like this.
Time.
Yeah, price of time.
The real story of interest.
Real story of interest. Yeah. So he talks about like how the Austrian school would look at something like this. Quotes from like Hayek, from Mises, and from Bastiat, saying that basically, we can attribute a huge part of so. Going back to the whole situation with the problem with interest rates started after 2008, right? Because in order to respond to that crisis back then, which was a big problem, central banks lowered rates down to zero. They couldn't go below, obviously, so they had to invent quantitative easing. So they did massive amounts of quantitative easing, and that kind of created this whole enormous tech bubble that a lot of us benefited from. Clearly, you had a lot of the whole look at the rise of private equity, the rise of VC, that all happened in that decade because money was cheap, and whenever money is cheap, it goes to funding potentially innovation, but also with that you can sometimes get bubbles. Clearly,
slopped.
Yeah, exactly. And so at one point so after COVID, you got like QE on steroids. It was much worse than before, right? And some of that obviously translated into higher inflation. There was a fiscal element as well. So Trump sending out checks, Biden sending out even bigger checks. Yeah. That was a contributor to inflation. Then there was a whole supply chain issue. So and now the system is we became basically stimulus junkies. If you were to go back on that, you would create a lot of problems for the economy, essentially. But in the short term, right? But in the long term, I think it's necessary, right? So right now we're in a situation where debt levels of governments are huge, right? So people are comparing this to the 70s. But in the 70s, you had debt levels that were like US was what, 25% debt to GDP. Now it's over 120%. That's a huge difference. It's 5 times difference, right? And as we said, if you have to pay 4.5%, 5% on that, that's a big burden on the budget. Obviously, we got used to low interest rates for a very long period of time. I don't think that's sustainable. And to be honest, in my own view, going down, to 1% interest again, pumping up the economy is just going to create a massive bubble in the end.
Yeah, no, that's fair, and I like that Austrian perspective. Actually, how Scott and I met was getting similar degrees in that field. So
cool.
Okay, so you gave me a good outlook on it. What do you think Jerome Powell is going to be doing?
Sure.
On Friday, so we'll put this out Thursday, and
sure. Yeah. So again, maybe I'm wrong, right? But I'm leaning hawkish, right? I'm leaning. So last meeting in July, right? That was a couple of weeks ago. I don't think much has changed, to be honest. So you mentioned the PPI and the CPI, so the inflation, the producer, and the consumer. So yes, there is no consumer inflation because at one point we can clearly see this. The prices of some goods that are going up, the import goods, they're being eaten by the producers, they're eaten by the companies. So they're not being pushed to the end consumer. The reason is probably because of already high prices that we have at the moment.
Yeah,
the price levels are high.
I was thinking about that when I was reading. I was like, why would you not? Because that's what everyone expects when you talk about tariffs. That was the mantra on CNN. It was the mantra on everyone. Was like, hey, this tariff is going to be eaten by the end consumer. But as you noted, that data points out otherwise.
Exactly. I mean, one of the hypotheses is that it could be that firms are afraid to do this because it will alienate their customers, right? Because, I mean, okay, so inflation is down, obviously, right? But it's still inflation. Prices are still going up. So inflation is the change in prices. So it's no longer, prices are no longer growing at 9% a year, but they're growing at 2%, 2.5% per year, which is still growing, right? So if you think about how much you were paying for meat 5 years ago or eggs or whatever, how much you're paying today, people notice this. They remember, right? It wasn't that long ago. Like, okay, when you remember prices when we were kids, like 20 years ago, fine. Yeah, of course, ice cream costs more and whatever, right? But things that were just like a couple of years ago, I remember I was buying meat, I was buying groceries at these prices, and now they're higher. So if you want to push that even more, it's gonna alienate people even more, and that's what some of these companies are afraid of, especially those that are sensitive to and as importers, right? They're importing foreign goods. So I'm guessing that the reason why they're not pushing it yet is because of that, because they're fearing that a further increase in prices might get them to lose customers and therefore give up even more revenues.
So I'm going to do a sidebar really quick, and this might be an unfair sidebar, but I'm curious how that's like reflecting into stock prices. That gives us like a good kind of glimpse into how people are understanding company revenues, and if all these companies are eating that means like their profit margins are thinner. I would assume you'd see some of that reflection in the stock market, but we're at all-time highs. Every single dip gets eaten up the next day. Like is there any sort of way to understand how that's getting priced into the market, or is it everything just looking forward to May of next year?
So the way to think about this is to decouple the market into two segments. One is the top 7 companies that are basically half of the market, 60% of the market, that are driving everything. And the other is the S&P 493, which is basically flat for the last few years, if you look at it, right? So to answer your question, these top the Mag 7 companies, you have Nvidia there, you have Meta and Google and Microsoft. All these companies are not as sensitive to tariffs specifically. Okay, Apple, Amazon to some extent, yes. That's why you see with the Apple price, it's not riding as high. But some of these companies like Nvidia or Meta or Microsoft, they're pulling their weight enormously. Their earnings are fantastic, right? So, and that's one of the differences between people are kind of making these comparisons between now and 2001 when you had the same type of concentration. But in 2001, there was a lot of companies that didn't make any money and were supremely overvalued, right? 2021, if you remember, it was a similar situation to some extent, but still the market was driven by these huge 6-7 companies that have real revenue. It's not fake. It's not. Yeah. These are the biggest companies in the world. Nvidia is bigger than the German economy at this point, right? Their market cap. Microsoft as well. So we're talking about these numbers are enormous, and that's and also the reason why that's the case is, again, all these flows from across the world coming to the US, investing where? in the S&P 500, and specifically in these companies. And that's the reason, right? So you have these automatic flows, automatic flows. You can look at 401k accounts, and you can look at the pension funds throughout the world, investors throughout the world coming into the US. So when the tariff thing happened, one of the reasons why we had such a big slump, like it was a 20% decline in the S&P across risk assets, is because investors were afraid they were kind of moving away from that model of, US being the capital inflow of the world. Because so what Trump wants to do, he wants a current account surplus, right? So he wants to have higher exports and imports. But if you have that, you have a capital account deficit, means the capital is getting out of the country, not coming in. Whereas the US for the last 30 years, the model has been, yes, we're a net importer of goods. But we import cheaper goods and we export more expensive goods. Like, we're going to import commodities and we're going to export computers, Apple phones. That's a pretty good deal. You get an Apple phone from China. What do they pay? They retail $300, $400. They charge $1,000 for the customer everywhere around the world. So that's a good type of deal. On the other hand, that kind of situation make sure that there's a huge amount of capital flowing into the country. So if that's disturbed, if the US wants to structurally change things, okay, it's a political thing. It's a political question. Fair enough. But if that happens, then you cannot justify the high valuations of the US market. And one of the reasons why we're kind of back to all-time highs is because the market investors, at least this is what I hear from people speaking on the street, is that, okay, they're expecting Trump to back off. To some extent, he did. He got negotiated deals. Tariffs went down to 10, 15% for most of his trading partners. And that's expected. That's fine. That's not going to disturb this whole model of expecting these huge capital inflows coming into the country.
Gotcha. Okay. That makes more sense now.
So that's like a macro perspective of why these things, happen and why the US is still, attracting huge amounts of money every month, essentially.
We're going to keep moving along here. I want to go back to the Jackson Hole thing. So you gave your expectation for what you think is going to happen. What is your... I guess you can't really tell me what your fund is doing because that's where the edge is.
I don't even know, to be honest. We get the signal tomorrow, so I don't know.
Signal comes tomorrow. Okay, we'll have to slice in a comment from you on what the signal is there. But what do you think the market's pricing in?
Okay, so I think it is pricing. I think it's expecting we're in for a little bit of a correction. So we could get a little bit of a correction. So typically we're also getting into this kind of seasonal weakness period. Typically end of August and early September. Yeah. It's like until mid-September, you get this seasonal weakness, just like you always get it at like end of February until mid-March, because you have these very big quarterly expirations of options and you have these kind of flows that are acting differently. Yep. And obviously, it's seasonality doesn't have to mean anything, right? One year it can happen, the other year it doesn't. But there are certain kind of reasons why this would happen. So if there is a negative trigger from Powell, we can expect this traditional weakness to kind of act towards a catalyst for a correction. Not a big one, not like April probably. Yeah. But if there's a negative signal from Powell, then we can expect like a sell-off, right? Again, I don't think it's going to be bought. I don't know, when it could be bought, like immediately on Monday or Tuesday. But so last time after the last FOMC, there was a sell on Thursday and Friday, and by Monday we were already going back up. It took 10 days to get back to all-time highs, right? Okay. Maybe the same thing happens now. We'll see. So you can never know about these things, but kind of in the medium to long runs, like for next year, because of the reasons what we mentioned initially, that like the fiscal stimulus, the monetary stimulus that we're expecting, I think it's very hard to be bearish, to be honest. Like
very hard to be bearish.
I think like bullish is the most likely outcome over the medium term. Okay. So we might, correction here and there can always happen, but like just because of the macro implications, right? Accommodative monetary policy, accommodative fiscal policy, these things are not not sell-offs, not inducements of sell-offs.
No, it's a good note on September. I think Bitcoin has had like one positive September in its history. It's normally just so brutal, and so everyone just kind of hands off, just hold spot or whatever.
There's a bunch of theories why this is the case, right? Some of them have to do like institutional flows. Some of them are like, people are, they come back from vacation. It's a little bit depressing to be back at work, so you're selling. These are just theories, right? No one knows. But there is some seasonality there, right? So yeah,
I like that vacation idea there. That's funny.
I don't know, you're depressed, right? Back to work. You don't want to. Yeah.
Makes me feel better. Have USD in the bank account. And just move it out.
Exactly.
Yeah. Okay, so you are expecting a cut basically from, or the market's expecting a
No, no.
cut.
So the market is pricing in a cut right
Yes,
now, right? For
but
September.
for September.
But if Powell, so like we can get several things from him. We can get like a fully dovish view where he says, "Fine, all right, we'll cut," and then in that case we go up. We knee jerk up. If he says, well, I don't think, this inflation thing is getting us worried. The producer, it's going to eventually trickle down to the consumers. We're not, not cutting silver, takes it off the table. Then it's a huge sell. In that case, go short, like whatever, right? But it's probably going to be something in between as usual. He's probably going to say, so again, look at like the rate cut expectations after the speech, right?
Yeah.
If they get aligned, the probabilities go down significantly, then it's a sign that investors are now. So what's priced in, to answer your question, directly.
Yeah.
What's priced in right now is a September cut for sure, right?
Okay.
If Powell takes it off the table or hints at taking it off the table, that's a sign for a sell-off, right? But if he reinforces it, then we keep pushing up.
Yeah. Are you guys? This is another sidebar. Are you guys using polling market or anything like that to kind of?
No, unfortunately not. I mean, we're looking at different things, right? Our signal is kind of the most important thing right now. We are kind of developing different strategies and different ways of trying to work around it for now. Develop kind of a multi-strat type of model. But no, I mean, these are like, my opinions. I don't want to echo them too far to my, a group of people who are in the survey. So I want to get their unbiased opinions. I nudge them a little bit, but so we'll see.
We are Cleanspark, America's Bitcoin miner, a publicly traded company with the largest operating hash rate, powered entirely by self-operated infrastructure across 4 states. This is our proof of work. We are setting the standard for what's next. Learn more about the intersection of energy and Bitcoin at cleanspark.com.
So let's talk about risk assets. I think most people, and this could be a short part of the conversation because it might just be like, hey, rate cuts, it's going to rip. But I would be curious if there's like any more nuance here where it's like any of these assets that are like Bitcoin mining, Bitcoin related, the AI HPC stocks that we kind of cover now, like CoreWeave. Is there any expectation that they would trade which way or the other based on market sentiment around that? Historically, it's been like, they rip if rate cuts
of course.
happen.
I mean, so right now, Bitcoin is you probably noticed this, it's very correlated to like the Nasdaq or the S&P as well. And the reason is because of institutional adoption. So like Bitcoin's own success is kind of, giving it a hard time because it's correlating it to a lot of other risk assets. Typically what Bitcoin is, the idea is it's supposed to be this great inflation hedge, right?
Yeah.
So when inflation is going up, Bitcoin should go up as well because it's kind of, you're switching money to a safe haven. But with institutional adoption, so they treat it as the risk asset. So the first thing you get rid of during a sell-off is your riskiest asset, and that's Bitcoin. Remember 2022, same thing. Like, we were talking about huge inflation. We were talking about Fed cutting rates. Fed hiking rates. Bitcoin goes down like 70%. Right?
Yep.
Okay, this happens every now and then Bitcoin goes back up, and that's fine. But this whole element of correlation is kind of killing the basic fabric behind the idea. It's helping you push prices up during good times, but during bad times, it's not really acting as what it's supposed to be, this great hedge, like, how it's envisioned. At least that's my opinion, right?
Yeah.
I mean, on the other hand, obviously investors are happy when, it's going up to all-time highs. But this correlation with the market makes me as fund manager think about what are the other hedges that you can use to kind of protect yourself during downturns, because that's kind of when you want to have the most protection.
Okay. And what other things have you been thinking about on that side?
That's the reason. So gold has been incredible in that perspective. Yeah. And the reason is, but it's not so much as kind of a hedge of people from equities going to gold, it's people from bonds going to gold. So you used to have portfolios like the 60-40 was like the gold standard, right? Not like the gold standard, like the standard portfolio for fund managers. Like every pension fund, if you do 60-40, no one's going to fire you, right? All right, you're doing it, whatever. You just like, switch between, what you want to emphasize. But the 60-40 portfolio during 2022, when inflation started going back up, was a big problem because all of a sudden equities are going down 20-30% and bonds are going down 20-30%. So you really have no way to, to escape. So I think like if you look at gold and their its ascent over the past few years, I think it's like a lot of these big investors switching their bond portfolios, part of their bond portfolios towards gold. And that's what's creating all this huge demand.
Interesting. Yeah. I mean, I know a few people who've been locked in gold trades for a while and they're pretty happy.
I mean, listen, gold is, I love it because it's kind of it's a store of value. I mean, it's not going to get you rich, let's be honest, right? But it's a store of value in a sense that 100 years ago, in 1925, you could have bought with 10 kilos of gold, 10 kilos. Sorry, I'm European, so I say kilos, not pounds. I don't know. That's 15 pounds?
I cannot tell you.
I'm sorry.
But I'm sure the audience knows, so it's
10
all
kilos
good.
of gold could buy you, so that's about $900,000, I think.
Okay.
Or that could buy you a huge house back then. Like obviously with a lower dollar amount, we could buy you a mansion, right? Today, also we can buy you a huge house, right? So that's what I'm saying, right? 10 kilos 100 years ago, 10 kilos today, 10 kilos 100 years from now, it's probably going to give you the same thing, right?
Yeah.
It's not going to make you rich, but it's going to preserve your value at least. That's its idea. That's why you don't put your whole portfolio in gold, but you put 10, 15, 20%, whatever your preferences are.
But that's not really the mandate of Orca, right? Like the mandate is to go.
Not at all. No, for us, for Orca, you mean?
Yeah,
so
for Orca specifically, because I think your guys' model is really interesting too.
Yeah.
A lot of people who certainly listen to this show and are in the Bitcoin mining, the HPC stock trades, like they are just hunting for, I mean, they're pretty reckless, 10Xs just across the board and, patiently waiting for that pop and then get out and to roll into the next one. Different than what you guys are doing. You guys are chasing volatility through signal, but I think there's some interest there from that crowd. Be like, how's a professional money or a hedge fund manager running this?
No, absolutely. So this is kind of my ideas in general about something that I do myself, right? So my own portfolio, most of my money is tied in my fund, obviously, right?
Yeah.
But the fund itself, it's so right now what it's trading options in the S&P, and that's it, right? So we're using, as I mentioned, these signals. We're trading very small risk, but it can deliver us 30% annualized return. So we're happy with that. Our investors are happy. We want to kind of diverge into more strategies, but we'll be talking about that later with our investors. But it's not really, we're not really your average portfolio manager in the sense that I can say, allocate a little bit, we're going to do a little bit of gold, a little bit of Bitcoin, a little bit of bonds, whatever. No, for us, it's kind of very, very simple so far, right? So we're still we got to get a name for ourselves first. We got to prove ourselves that we're good at this, and then we can kind of branch out into different things.
Gotcha. Well, let's finish up with a little more on the tariff conversation. So
sure.
The last thing, and a little bit more on Jackson Hole, the last thing you noted was market is going to price in a cut for September, probably is what we're seeing. And then certainly a rate cut in May of next year, should we bring on someone. So some of your notes from your newsletter also indicated that, that 1.5% plus cut that Trump wants, kind of overkill, but there's certainly maybe a place for a cut in the near term, and the market's predicting that. What are you thinking through the end of the year when it comes to tariffs, rate cuts, other things? What are the sort of things that you guys are looking at? Maybe a good way to put this in the perspective of Orca is what are some of those events you guys are prepping your surveys around? The China tariff standoff that keeps getting punted 90 days is one thing I was interested
about.
Getting
tacoed.
Yeah. Really talking.
Right. Again, so we were, you're right. I mean, for us, events are interesting. That's why every FOMC event for us is interesting. Jackson Hole for us. So we're going to be trading, watching it very actively on Friday. So that's very important. But also the tariff announcement. So I knew that April 1st was going to be a big thing. And we were kind of, ready to, but we got a short signal. I think that was one of the strongest short signals that we ever got.
Yeah.
And it was before. So he announced them on Wednesday after market close. We got the signal before. It was a short signal, and I think everyone in the survey was short. Everyone was expecting something bad to happen. So okay, it's too bad we didn't increase our risk exposure at that point. But we our models don't show that to be beneficial. But okay, in hindsight, maybe we should have.
Hindsight is kind of risky, though, right?
Exactly. So you don't want to overdo it, right? Yeah. But anyway, it was a great opportunity. So right now, I think with the whole pricing in of tariffs, I think it's fully priced in that it's not going to be a big deal, right? So it's not going to be a game changer in terms of what we talked about, the capital flows for the US, and that's important. So what Trump did get is a political victory, and that's very important for him. So he got a lot of these countries to sign deals with him. That's what he wanted. He's getting some of them to invest in the US. We'll see how that happens. So for example, the whole European deal, I don't know if you saw that. That's I think it's a huge defeat for Europe and a huge victory for the US. And the ability, the way that he managed to get that is frankly incredible. But that's what you get when you send bureaucrats to negotiate business deals. They don't they don't excel at that. What they do excel in, however, is the details, right? The fine print. So now we'll see. We have to see what the end deal is going to look like.
Yeah, there's a little devil in the details, as they say.
And this is where they're the masters, right? Trump is great in like making a deal, but they're great at like refining the deal. Let's call it that way. We'll see what happens. But I expect the same thing from China. I think it's not going to be a trade war. So remember, I think it was much worse in 2018, the trade war with China, than it is now. Also, markets reacted back then. If you remember, it was a sell-off. It was also Bitcoin also sold off. Right? It was 2018. Right?
Yeah. We had a little pump into summer 2019, and then it corrected, and everyone was out again.
Yes, exactly. So that's the thing. I think he's going to go. They will make some sort of a deal. He will proclaim another political victory, and basically when he communicates this, it's going to say, we made all these deals, we made all these countries pay, we're not being treated unfairly anymore. Fantastic, right? But he's not disrupting the whole system that we talked about, which is, a lot of people that supported him were kind of telling him and trying to influence the administration back in April, Bill Ackman being one of them, saying, all right, and Jamie Dimon, I think, as well, saying, guys, okay, let's kind of, what are you trying to do here? And I think, like, as the markets realized that it's not going to go down the way they feared, we started kind of grinding back up.
Oh, I got you for 2 more minutes here. I'm curious, like, do you like the overall strategy of just kind of like trying to hammer down rates, get that 10-year under control? Do you think it's going to pay off and work?
So again, from a political perspective, I think it's great. Absolutely. Like from a short-term political perspective, doing that, getting rates down, getting your borrowing costs down so that you can push your agenda, fantastic, right? From a long-term health of the economy, I think we're going to inflate another bubble. That's what I'm afraid of, right? So, we're talking about comparing this to 2021, comparing this to 2001. Right now the valuations are as big as were there, but there's so much money still in the economy. We can still expect this bubble to keep inflating, right? Before we get like a massive correction. I don't know when that's going to happen. If I knew when that was going to happen, I would already be a billionaire, but that's not the case. But I think like if we keep overstimulating, we're going to get a big sell-off at one point.
Hey, thanks so much for joining us today.
At that point, that's a buying opportunity. Buy the dip, right? If you get like whenever, so I got a few of my friends asking me, when is Bitcoin going to fall 80% the next time? Like, man, I really don't know. Like, if I knew, I would already do something about it. But if it happens, go all in, right?
That's a great question to end on. Do you think Bitcoin is going to have a 80% correction with all the institutional flows?
So I'm looking at these like patterns that Bitcoin does it every few years, right? And it rides up, and then has a massive correction, and then it's a great time to buy. So again, if it happens, great time to buy.
Okay.
That would be my suggestion.
Vuk, we'll close out there. Thank you so much for making the journey up to West Village from FIDE. I appreciate your time.
Absolutely. Thank you so much for the invite.